I have seen a lot of reels recently that I need to debunk. Your child will not be responsible for hundreds of thousands of dollars in taxes if they inherit your primary residence or any other kind of asset. In the event of death, for tax purposes, it is assumed that you have sold all of your assets at the fair market value on the date of death. This is obviously not an actual sale, it is an assumption that is made for tax purposes. The reason for this is the person has to be responsible for any gains that they have made in their lifetime, so it does not pass on to someone else. Even though this is an assumed sale, any tax exemptions that apply for personal belongings and primary residences still apply. Let's take an example here from the parent's perspective. We'll look at the child's perspective after this. Let's say a parent purchased a house for $100,000 and on the date of death, the fair market value of that house is $900,000. Yes, there was a capital gain of $800,000, but the primary residence exclusion still applies and therefore you have a net gain of $0. From the child's perspective, they inherit this property at the fair market value on the date of death of the parent, which was $900,000. If the child decides to sell the property at some point in the future, but they also use this property as their primary residence, the same exclusions will apply for the child as well. Because of these tax rules, the child will only be responsible for the capital gains from the date they inherited the property until the date that they dispose of the property.